Hi guys, I am VP. In this video, we are going to see the chapter 1 in the book The Intelligent Investor. The chapter 1 is investment versus speculation and results could be expected by the intelligent investor. Okay, I summarized this chapter 1 into 6 points that are what is an investment and speculation and difference between investment and speculation, and third one is portfolio policy of an investor versus speculator, and fourth one is results could be expected by an investor and a speculator, and fifth one is commentary written by Jason Swag, and sixth one is conclusion given by myself. Let's get started. Okay, now let us see what is investment versus speculation. Okay, the formulation of difference between these two are: an investment operation is one which, upon through analysis, promises safety of principal and an adequate return. An operation not meeting this requirement are speculative. Okay, what does that exactly mean? It means that an investment operation is done by analyzing the company properly, their financial statements, their company background, who is the promoter, who is owning the company, and who is the management who is running the company properly or not. The financial statements they look is the profit and loss statement, does the company is making profit or not, and balance sheet like seeing the assets and liability of the company, like how many debt the company has, and the cash flow statement is like does the company is having a positive cash flow statement or a negative cash flow statement. Okay, now even though the company has a very sound business and very sound management firm, but the investor will always look thus it is the right time to buy the stock or that is the right price to buy the stock. If the price is overvalued, then the investor will always stay away from the stock. Okay, the speculator will always buy or sell a stock because maybe her friend suggests the stock, maybe he read in a newspaper about the stock, or maybe the broker give a tip about buying and selling the stock. Okay, if someone does this, then he is a speculative nature. Okay, now the second point is the difference between the investment and a speculator. Okay, what he buys, for what purpose he buys, and for what price he buys, whether with a cash or a margin trade. Okay, now what he buys, an investor will always buy a common stock and a blue chip stock which is traded for a long time in the stock market. But a speculator buys a stock only because of the news, or the company is very small or micro cap or a small cap company. Okay, for what purpose he buys? An investor buys with the purpose of a long term view, so that in the long term his price will appreciate and will get an adequate return from it. But the speculator buys a stock because the stock price would go up tomorrow or by the next week. For that purpose, the speculator buys a stock. Okay. Now the third point is what price he buys. The investor will always buy the price near to the intrinsic value of the company's price. That is, the investor will always evaluate a company for a price and he waits until the price comes near to this price and he will buy the stock. But for speculator, it's just a number for him. Where if the stock price goes up, he just buys, and if the stock price goes down, he sells. Okay. Now, whether with cash or margin, the investor will always buy a stock with a cash and takes delivery and wait for long term to get a return from it. But a speculator will always in a margin trade. Margin trade is nothing but getting paying money to the broker and getting a more leverage amount and buying a stock from it. Okay, in the margin trade, if the stock price goes up, the profit also goes up. But if the stock price comes down, then our account will be washed out from it. These are the difference between the investment and the speculation. Okay. Now the third point is the portfolio policy of an investment versus speculation. Okay. The intelligent investor portfolio should look like the combination of high grade bonds and the common stock portfolio. The ratio of this is minimum 25%, maximum 75% for both stocks and bonds. What does that mean? It means that in our portfolio we should not have less than 25% of bond or stock, otherwise more than 75% of bond or more than 75% of stocks. It comes around, if we have 25% of bond, we should have 75% of stock, not less than 25% of bond and not more than 75% of stocks, vice versa. Okay, now Graham also says that there are two ways in speculating, that are an unintelligent way and an intelligent way of speculating. Now let us see the unintelligent way of speculating. The unintelligent way of speculating are speculating when you are thinking you are investing. Okay, we should always know the difference between the speculation and an investment in a proper way. Okay, now second one is speculating seriously instead of a pastime. We should always speculate in the nature of our pastime only. We should never take it as a serious business so that our mind can be free from it. Even though we make losses in that, our mind can be free from it because we are just doing it for our pastime. Okay. The third point is risking more money than we cannot afford to lose. Graham advises is we should never put more money in trading that we cannot accept our loss amount for it. Whatever the amount we can accept the loss, that money only we should put in our speculative account. Okay. The intelligent way of speculating is Graham says we should have two separate accounts for it. One is for investing and another is for speculating. In investment account, we should buy high grade bonds and a common stock portfolio. That's it. But we should have a second account. In that second account is for our speculative nature. In that we can do margin trade, and he always advises is not add more money in the speculative account. It means that if we have a fixed amount to lose, then we should never add more money in that account. Okay, the only one main advantage Graham says for speculation is if we speculate, then we can get our hands into upcoming blue chip companies or upcoming multi baggers. We can so that we can enter the stock earlier stage itself. Even though the company's financially is not good, even though the company is profitably not good, but when we see it in a speculative nature, by the long term view, so that we can get a multi bagger stock in our speculative portfolio. Okay, that is the portfolio policy of an investor and a speculator. Okay, now the fourth point is results could be expected by an investor and a speculator. Now let's see it for a speculator. For speculator, there is no return percentage set by Graham. Whenever he is in profit, he can book it, or whenever he is loss, he can book it. That's what Graham says. But for intelligent investor, Graham differentiated into two categories. They are defensive investor and an aggressive investor. Now let's see the defensive investor. The defensive investor stock portfolio should look like high grade bonds plus common stock portfolios. That's it. Returns the defensive investor can expect is whatever the returns produced by the index, that returns the defensive investor can expect. If the index gives 15% return for a year, then the defensive investor also can expect a 15% return from his portfolio. Now the second one is the aggressive investor. The aggressive investor's portfolio should look like high grade bonds plus index funds plus some common stocks. Okay, the aggressive investor always spends his time and energy for finding out some non-common stocks so that he could expect a higher returns more than the common stocks. Okay, the results expected by the aggressive investors are slightly above the index returns. Okay, let us consider if the index gives 15% return for a year, then the aggressive investors portfolio should look like 17 to 18% return for that year. Okay, these are the returns expected by an intelligent investor and an speculator. Now, the fifth point is commentary given by Jason Zweig. Jason Zweig aspires the quote given by the Graham, that is, an investment operation is through an analysis of a security and promises safety to the principal and an adequate return from it. Jason Zweig break down the statement into 3 points. That is, you should thoroughly analyze a business or a firm before buying it. We should be thoroughly analyze the firm's business, the stock fundamental, the financial statements, and the valuation of the company. Okay. The second point is we should always deliberately protect our capital from the investment we are doing it in our stock. And the third point is we should always expect an adequate return from the stock, not an extraordinary return, so that our emotion could be controlled in the investment for a long period of time. These are the three elements Jason Zweig. It's an important from the first chapter. the investment versus speculation. Okay, let me conclude this chapter 1 by saying that don't speculate in share market. Rather than consider buying a stock as an being a partnership with the business itself, so that over a period of time you could get an adequate return from the stock market. And always keep your expectations lower as possible so that you cannot affected by your psychology to exit from a stock itself. Okay, this is for our first chapter, investment versus speculation. Let me see you in the second chapter, the investment versus inflation. Stay tuned. Thank you.